All right, let's talk VO versus VTI. If you're a beginner investor, you see these two tickers everywhere. In this explainer, we're going to make the choice between them super simple for you.
So this is the big question, right? Which one is the right choice for your portfolio? Let's dive right in and figure out what the real difference is and which one actually fits your strategy.
Okay, so here's the bottom line, right off the bat. VOO on the left, that tracks the S&P 500. It's basically just the 500 biggest, most powerful companies in the US. Now, VTI on the right, that tracks the entire US market. We're talking over 4,000 companies, from the giants all the way down to the little guys.
So that's the main difference, diversification. But, what does that actually look like? To really get it, let's try to visualize the whole US stock market.
Imagine this. All the publicly traded companies in the US are stacked up in a giant pyramid. At the very top, you've got your huge mega corporations. And as you go down, you get to the medium-sized companies, and then that huge wide base at the bottom, that's the thousands of smaller companies.
And VOO, it's all about the tip of that pyramid. It's completely laser-focused. It only invests in those 500 big, established companies at the peak. It's really a bet on the biggest and the most dominant players in the game.
Yep, that's its one and only job, to perfectly mirror the performance of the S&P 500 index. So when you buy VOO, you're buying a slice of the absolute titans of the US economy.
Now VTI, that's a whole different story. It doesn't just buy the top, it buys the entire pyramid. The top, the middle, that big base at the bottom, it's got the big guys, the medium guys, and all the small guys.
I mean, with VTI, you're literally buying a tiny piece of almost every single public company in America. It is the whole shebang. It's pretty much the definition of maximum US market diversification, all wrapped up in one fund.
All right, so we've got the top of the pyramid versus the whole pyramid. How does that actually shake out in the real world when you're looking at your account? Let's break down the numbers.
And here's what blows most people's minds. When you look back at how they've performed over the years, their returns are, well, they're almost exactly the same. Seriously, if you put them on a line chart, the lines would practically be right on top of each other.
So you might be thinking, wait, how is that possible if VTI has thousands more companies? Well, it's because those 500 giants in VOO are so massive, they make up more than 80% of the total value of VTI. Their performance pretty much drives the whole bus. The thousands of smaller companies just don't have enough weight to really change the overall direction.
Okay, what about risk? Well, there is a tiny difference here. VOO is technically a little less volatile, a little less bumpy, because it only holds those huge, stable companies. VTI, since it holds smaller companies too, has just a teensy, almost unnoticeable bit more volatility.
And cost? This is the best part. It's a dead heat, a perfect tie. Both have an incredibly low expense ratio of just 0.03%. And this is awesome because it means fees are not going to be the reason you pick one over the other.
Yeah, just to hammer that home, 0.03%. That means for every $10,000 you have invested, you're paying a measly $3 a year in fees. I mean, come on, that's insanely cheap. It's a huge win for any long-term investor. Okay, so if performance is pretty much the same, and the cost is exactly the same, and the risk is barely different, how on earth are you supposed to choose one? Well, it actually comes down to your personal philosophy.
It really just boils down to this. What's your personal take? You go with VOO if you like simplicity and you believe that America's 500 largest companies are always going to be the main engine of growth. You pick VTI if you're a believer in maximum diversification, if you want to own a piece of everything, not just today's winners, but tomorrow's potential winners too. It's about which story helps you sleep better at night.
Let's just zoom out for a second, because it's so easy to get bogged down in these little details. What's the really big, important takeaway here? If you remember just one thing from all this, let it be this. You really, truly can't go wrong with either one. This is not some high-stakes make-or-break decision. You're choosing between two absolutely world-class options.
Look, both of these are just fantastic, low-cost tools for building wealth slowly and steadily over the long haul. Tons of very successful investors own one or the other, or hey, sometimes even both. The most important thing is just to pick one and start investing consistently.
And at the end of the day, that's the choice it all comes down to. The question you've got to ask yourself is, are you betting on the star players, the proven giants, or are you betting on the entire team, from the all-stars down to the up-and-comers. The right answer is simply the one that feels right to you.